Hi everyone, I had to walk into this market today from scratch, knowing what I know about Nvidia at fresh highs, Micron suddenly acting like the memory market owns the whole AI story, CoreWeave sitting in the middle of a debt-fueled infrastructure race, and SoFi quietly trying to build a larger investing machine. I would not treat this like a normal market update. Most people think this is about green candles, red candles, and which stock gets the biggest cheer on a Tuesday. But that is not what this is about anymore. We are watching the market decide who owns the infrastructure layer of the next economy. And today, Tuesday, May 12th in New York, that is exactly where the story begins. Tell me in the comments what day and date you are watching from, because by the time most people notice a trend like this, the easy part is already gone. And quickly, if you value original work and you do not want this channel buried under copycats, subscribe and comment John A.G. Best. Keep it simple. That tells the algorithm real research still matters. So in this video, we are going to walk through Nvidia, Micron, CoreWeave, Nebius, AMD, SoFi, the new IPO setup, and the uncomfortable question behind all of it. Are investors still buying the beginning of the AI infrastructure cycle, or are they already paying future prices for future perfection? Because that is the part nobody likes to say out loud. Let's get started. First, Nvidia. If you own Nvidia, the market has basically been tapping you on the shoulder and saying, fine, maybe you were not crazy. The stock moved back into record territory, and the company is now valued like a separate country with a ticker symbol. But records by themselves do not make a stock safe. They change psychology. At highs, owners feel brilliant. People who sold too early feel miserable. People who never bought start calling it a bubble because that is easier than admitting they missed it. And bears move from, this can't happen, to, well, it already happened, so now it can't keep happening. That is not analysis. That is emotional accounting. Based on recently published numbers, Nvidia's last reported quarter was not some small beat hiding behind hype. Revenue was around the high 60 billion range, data center revenue was around the low 60 billion range, and full-year revenue was well above 200 billion. In normal companies, numbers like that come with slow growth. Nvidia is still behaving like a growth company wearing a mega-cap costume. Now, does that mean you close your eyes and buy anything with Nvidia on the label? No. Please do not turn investing into a religion. The reason Nvidia still matters is not just the chip. It is the stack. Compute, networking, software, systems, supply relationships, developer habits, and the fact that customers building massive AI facilities do not want to gamble with second-best infrastructure when every month of delay costs them market share. That is why the AMD debate gets so heated. AMD can win business. AMD can rally. AMD can benefit from the same demand wave. I'm not sitting here pretending AMD is irrelevant. That would be lazy. But here is the question. When the customer has one urgent call to make, who gets the first call? If the first call is Nvidia, then AMD is still fighting for overflow, price-sensitive demand, and customers who want leverage against the leader. That can still be profitable, but it is not the same position. And in markets, position matters. This is also why memory has suddenly become the part of the story that a lot of people underestimated. Micron used to be treated like a boom and bust memory stock. Good when pricing is tight, terrible when supply floods the market, and painful if you arrive late. But AI has changed the conversation. The latest company commentary points to record levels across revenue, margin, earnings, and free cash flow, with management openly saying memory is now a strategic asset in the AI era. That phrase matters. Strategic asset, not spare part. AI models are not just asking for more intelligence. They are asking for more memory, longer context, faster retrieval, more storage, and more high-bandwidth connections between everything. A model that cannot remember, move data, and serve users quickly is like a genius locked in a room without a phone. So when Micron starts moving violently, you have to ask the right question. Is this just another memory cycle, or is this the market repricing memory because AI workloads are becoming permanently heavier? Those are not the same thing. If this is just a tight pricing cycle, then eventually supply responds, margins normalize, and late buyers learn the old lesson again. But if this is a structural change, then memory suppliers are not background characters anymore. They are toll booths on the AI highway. Still, do not get hypnotized by a chart. A stock can be right and risky at the same time. Micron can have real pricing power and still become overextended. Investors can be early on the theme and late on the stock. That is why you have to separate the company from the entry point. Now let's talk about CoreWeave. CoreWeave is the kind of company that makes both bulls and bears sound smart, which usually means the story is actually interesting. The bull case is obvious. Revenue is now running in the low billions per quarter. Backlog is just shy of 100 billion. The company has signed large commitments with major AI customers, and it sits directly in the path of customers that need compute now, not 5 years from now. The bear case is also obvious. This is not a lightweight software company with clean margins and a tiny cost base. This is an infrastructure machine. It needs data centers, GPUs, power, networking, debt, leases, and constant capital. It has to spend enormous money before the long-term economics fully show up. So the question is not, is CoreWeave growing? Of course it is growing. The question is, can CoreWeave turn that growth into durable cash flow before the cost of the build-out becomes the story? That is the knife edge. Based on the latest publicly available filings, the business shows strong adjusted earnings power, but also heavy losses after interest and other costs. That is not a tiny detail. That is the difference between a beautiful growth chart and a business model that has to keep moving fast just to stay balanced. And that is where Nebius comes in. People love comparing CoreWeave and Nebius because both are tied to the AI cloud build-out. But they are not the same animal. One is moving with an aggressive infrastructure footprint and a very heavy financing profile. The other may look cleaner in some ways, but can trade at a richer story multiple. So you cannot just say cheaper equals better. Sometimes cheaper means misunderstood. Sometimes cheaper means the market is seeing the risk before retail does. The better question is this: which company can deliver the most useful AI compute at the best economics while still surviving the power, financing, and supply chain bottlenecks? Because that is what customers care about, not our feelings. Customers care about throughput, reliability, price, availability, and whether their engineers can actually get workloads running. This is why specialized AI cloud companies can exist beside the giant cloud providers. The big clouds have scale and ecosystems, but the specialists can sometimes move faster for specific workloads, especially when AI labs and enterprise customers need dense clusters and immediate capacity. But again, there is a counterpoint. If the largest cloud companies ramp supply fast enough, and if Nvidia allocation becomes easier, and if financing costs stay stubborn, then smaller AI cloud players may find out that demand is not the same thing as profit. That is why I would not analyze CoreWeave like a simple momentum trade. It is an infrastructure leverage story, and leverage cuts both ways. Now zoom out for 1 second. The AI trade is no longer just chips. It is power. It is cooling. It is fiber. It is land. It is grid connections. It is transformers. It is gas turbines. It is utilities signing massive load agreements because data centers are changing electricity demand in the United States. Recent energy forecasts show U.S. power demand is expected to push into record territory, with data centers playing a major role. Global data center electricity use is also projected to roughly double by the end of the decade. That is not a side note. That is the physical limit of the AI story. So when you see power names, networking names, memory names, storage names, and data center suppliers moving, that is why. The market is following the bottlenecks, and bottlenecks are where pricing power hides. That does not mean every power stock is suddenly Nvidia. It does not mean every fiber company deserves a moonshot valuation. It means the AI supply chain is widening, and investors are trying to find the next choke point before everybody else sees it. This is also why new IPOs are coming. Every cycle needs fresh merchandise. Private companies see public investors hungry for pure plays, and public investors see private companies as a chance to buy the next Nvidia, the next CoreWeave, the next infrastructure winner. But slow down. An IPO is not a gift basket for retail investors. It is usually a financing event, a liquidity event, or a story being sold at the moment the market wants that story most. Some IPOs become monsters. Some become very expensive lessons with nice investor decks. So when a new AI name comes public, do not ask whether the company is exciting. They are all exciting. Ask what has to go right for the valuation to make sense. That question will save you money. Now, SoFi, this part looks smaller than Nvidia and CoreWeave, but strategically, it may be more interesting than people think. SoFi already had a platform strategy: banking, lending, investing, technology services, and a customer base that keeps getting larger. Its most recent quarter showed record revenue, record member growth, and record product growth. That tells you the company is not just surviving. It is still expanding the ecosystem. Now it appears SoFi is moving deeper into investing infrastructure. Primary Bid's technology has been tied to retail access for IPOs and directed share programs, and SoFi had already worked with Primary Bid on a platform for companies raising capital in the US. That matters because retail IPO access is one of those areas Wall Street has historically kept behind velvet ropes. If SoFi can make IPO participation easier, cleaner, and more integrated into its app, that fits the long-term platform vision. Then there is Composer. Public brokerage records show SoFi Technologies, listed through Composer Technologies, as a significant indirect owner of Composer Securities, with the relationship starting in March. That does not tell you every strategic detail, but it does support the idea that SoFi is pushing toward automated investing, AI-assisted strategy tools, or a more advanced trading layer. Now, I want to be balanced here. AI trading sounds exciting. It also creates risk. If customers think a machine is going to turn every plain English idea into profit, that is dangerous. Backtest can look beautiful. Real markets can be rude. Regulators will care about disclosures, suitability, execution quality, and whether customers understand what they are doing. So the bull case is that SoFi becomes a broader financial operating system. The bear case is that the company keeps adding pieces that take time to integrate, while investors want proof that each piece drives revenue, retention, and profit. Both views can be true at the same time. There is also the insider timing discussion. When an executive buys stock and then investors notice acquisition activity nearby, people ask questions. That does not mean anything improper happened. It may be completely clean. Deals may be non-material. Legal teams may have approved everything, but optics matter. If you run a public company, you want fewer gray areas, not more. And this is where I want investors to be grown-ups. You can like SoFi and still ask hard questions. You can like Nvidia and still admit valuation risk. You can like Micron and still respect memory cyclicality. You can like CoreWeave and still worry about debt. That is not negativity. That is how you stay alive. Markets are full of fandom right now. People want a team. Nvidia team, AMD team, SoFi team, Micron team, CoreWeave team. But portfolios do not care about team spirit. They care about price, time, risk, and execution. If you're successful, share your success story in the comments so others can stay motivated. There are people watching quietly who need to know discipline still works. So here's the framework. Own the leader when the leader still has improving fundamentals. But do not ignore the price. Watch the bottlenecks because bottlenecks create pricing power. But do not assume every supplier becomes a monopoly. Respect second-place companies when demand is overflowing. But do not forget that overflow demand can disappear if the leader catches up. Study the balance sheet before falling in love with growth. Growth financed with heavy capital can be wonderful, but only if the cash flows arrive on schedule. And with Fintech, do not confuse product expansion with automatic shareholder value. Strategy is only valuable when it converts into trust, engagement, revenue, and profit. That is today's market. Nvidia is still the center of gravity. Micron has forced investors to respect memory again. CoreWeave is one of the most fascinating high-growth, high-risk infrastructure stories in the market. Nebius is not identical, and that difference matters. AMD can win, but it still has to prove it deserves leader treatment. SoFi is trying to move from financial app to financial platform. And the IPO pipeline is getting louder because money always rushes toward whatever story is working. The opportunity is real. The risk is real too. And one more thing. Do not let one strong market day convince you every question has been answered. Earnings still matter. Guidance still matters. Power contracts still matter. Customer concentration still matters. And when a company needs constant capital, the stock market is not just voting on growth. It is voting on trust every time. So do not ask, what is up today? Ask, what is to remain true for this move to keep working? That one question will separate investors from spectators. I am not your financial advisor, and this is not a command to buy, sell, hold, chase, panic, or worship any company. This is educational market commentary built to help you think through the setup before risking your own money. Do your own research, know your time horizon, understand your risk, and make decisions you can actually live with when the market stops clapping.